This individual, they've got an LOI signed. It's 42 units, 6,000 square foot facility, a great amount of rentable square footage on 4 acres.
Do not think that storage has to be millions and millions of dollars. Like, you can find storage facilities for less than a single family home. This is under $250,000, $4,200 down. Very low down payment to be able to get into a storage facility. Great job on getting some of this creative financing in here while still being able to have the long-term aspect of owning the asset.
What is going on, everybody? Today, we have an amazing episode because we're taking real-time information from our online educational platform, Self-Storage Income, directly from our members, the questions that they're posting, in our community posts and forums and so forth. And we're bringing them straight to you guys and sharing the challenges, the wins, like what they're seeing, what they're experiencing, and some of the questions that they're asking as they're going out, acquiring facilities, analyzing facilities. It's such a great episode today, man.
Yeah, this is a good one. We're going through things that people are working on right now, questions that they have, deals they're working on. And, our thought was if they have these questions, and you guys might have the same questions as well, too. So really excited to dive in today.
100%, man. It's so important. All right, this first one, we've got this individual, they've got an LOI signed. It's 42 units, 6,000 square foot facility. So not massive, but a great amount of rentable square footage on 4 acres.
Yeah.
They did this situation where they're doing a small amount of money down, less than $5,000 down, and they're doing like this lease to own scenario where they're coming in and their payments start 90 days from the time that this person's coming in after the quote unquote close, let's say, and it's all applied to, it looks like a $230,000 purchase price. And then they've got 2 years later, it's about a $200,000 balloon essentially that it looks like is going on here. So they've got about a couple months, it looks like, to get in, get tenants out, or making monthly payments. If there's delinquencies, some of that. So when we're talking about getting tenants out, we're talking about the bad ones, right? Like when you're acquiring facilities, you might run into this situation where you have high delinquencies. That's low-hanging fruit. You can get those folks out. And again, if you've done your homework and due diligence, you've identified there's strong demand in that market for that storage type, and you can get those non-paying tenants out or those problem tenants out and replace them with the good, strong dream tenants, like we like to call them, that pay on time, that are less price sensitive, all those things, easier to work with. So that's what we're talking about here. Getting in, doing this value add over the next couple of years. Incredible, man. And this is just, it goes to show you the different ways that you can approach these potential opportunities and create a deal. We talk about making deals, and this is such a perfect example of that.
Yeah, for sure. We see we get the question a lot of lease options or master lease, things like that. And it definitely can work. We've seen it work. And I think it's being able to understand how you're going to structure an end result where you can benefit from the real estate aspect as well too. And so if you are just leasing and just running the business of it, you get the benefits of running a storage facility and getting the cash flow, but you miss out on the real estate aspects of it. So when you're doing, lease options, you want to be able to have some type of structure that you can still benefit from, appreciation, depreciation, all of the things that come with real estate. Again, that's why we love self-storage, because it's not just a real estate asset. It's a business on top of real estate. So you want to make sure you're benefiting from both. And so in this instance, he was able to structure an LOI that does allow for him to purchase it in 2 years, and the payments are going towards the purchase price for that. So I think that is a creative way that you can structure some of this to make that work, which is great. Like Connor is saying too, getting the tenants out so that way you can get the right tenants, all of this is still based on executing your business plan. So it's your purchase price and your deal structure is only as good as your ability to execute on it. And so the things that you would want to see in this is, okay, is there demand in this market? What are the other types of competition doing? This is a smaller facility. It's only 6,000 square feet. So what does an exit look like for this? It's two things to this. It's $230,000 for a purchase price, which is first off, do not think that storage has to be millions and millions of dollars. You can find storage facilities for less than a single family home. This is under $250,000. On the flip side, what does financing look like for this? This might be tough to get an SBA loan on where it's so low, you might be looking at a conventional loan or maybe somebody paying all cash for it. And so just thinking of those things in this is where the lease option comes in. Is this is only $4,200 down, so very low down payment to be able to get into a storage facility. So that's really great job on getting some of this creative financing in here while still being able to have the long-term aspect of owning the asset.
So many huge benefits here. I mean, that down payment, I don't know if you can get like a decent car for a down payment like that these days, right? Like, I mean, that's a low down payment, you know.
Right.
I'm sure there is out there. Somebody's going to correct me somewhere in the comments. Like, no, I just bought my Hyundai for no money down, tax season or whatever. I don't know, but no, this is a prime example, man. And we had an amazing podcast episode with Tanner Herget just yesterday. So if you guys at the point in time you're listening to this, just look for that episode with Tanner, and he talks about this strategy as well, where he would go in and as opposed to using leverage, like so many of us do, leverage is an amazing tool to have in your toolbox. But instead of going in, doing the down payment, doing this value add strategy over however many months or years or whatever, then pulling your money out, there's this velocity of capital issue where if you're constantly putting that down payment down on the first one, the second one, your money continues to be more and more tied up as you grow. And you can only deploy that capital so fast. And so for him, he got into a point where he says, why don't I come in and I pay all cash for this asset? I find a perfect value add facility that's got, I can increase rates, I can increase occupancy, reduce delinquency. He loved expansions. He's done a bunch of those. And the expansions are absolutely amazing equity creation. And strongly encourage you folks to try to find some of those out there. But he would fund everything up front, pay in full. And then once he executed that value add strategy, he would go and get the financing for the first time and then pull out his equity.
Mm.
So he would get all of his money back out. It would just allow him to move more quickly and get his money out a lot faster. It was kind of an interesting strategy. It was cool to hear how all these other folks are structuring these deals and making things work. And that's, I think, one of the biggest hurdles to try to overcome is figuring out like what strategy is going to work best for you as you dive into all these things. And I think until you actually get there, like you have to take the steps. You have to look at these opportunities. You have to do the underwriting and the market research and look at the resources that you have available or that you can pull together and evaluate what level of risk that you're personally willing to take, what business model you're going to operate with. Like only you can really decide those things. And again, I don't think you can really make those decisions until you have those opportunities in front of you. So don't try to like put the cart before the horse and get everything figured out before you jump.
Yeah, no, that's a great point. I think something AJ says is that, don't just take one bank's answer as the end all be all. And so you might reach out to one bank and they say, no, we're not going to finance this, but then go out and talk to more. Or, is there another way to structure it? Like you were saying, what Tanner's saying, where it's like, I'm just gonna pay all cash to start and then figure it out later. Not everyone may be in a position to do that either, but it's like, what opportunities do you have to structure something, and then how can you be creative with it? But I think the biggest thing is don't just take one no as like, oh, it's never going to work. Like a
Mhm.
lot, you just need to find one bank or one way to structure a deal, no matter how many no's you get. And so I think that's a big thing that, seeing these people in our community come up with these creative ways to structure things that may not have worked on a traditional financing standpoint. They're not using that as like an excuse to not keep moving forward and make things happen.
Yep. No, that's all great stuff, man. And I think a testament as well to this idea of being flexible as we're working through, analyzing opportunities and markets and not just saying, no, this is my strategy. It's black and white. I'm only doing this. And I think there's value in being disciplined in, markets and buy boxes and some of these things. But, that's the end goal. The path to getting there can change, right? That's something else that we talk about.
On my deal analysis call, the last one we just did was a vacant property. and the person doing it was like, this is not part of my buy box. I had no interest in vacant properties, but it's 3 hours from me and I love the market and I can see the value add here. And if I can get it at the right price, the returns are really great for me. So that's just exactly what you're saying. It's like it's a balance of like, we're not saying to get to this point of shiny object syndrome where you're just looking at everything on the planet because
Yeah.
you're just going to burn yourself out. But especially if you get too narrow in what you're looking for and you can't find that perfect thing, the reality is there's never going to be a perfect facility for you or a perfect business at all. And then it's just being able to like Connor said, what is the end goal? But maybe you need to be a little flexible on how you're going to get there.
Hey, podcast listeners. As you know, self-storage, we give away all our information for free. It's my open playbook, and I share with you guys every single week what we're seeing and what we're doing. But what a lot of people don't know is that we have even more resources available. So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
Moving on to the next question here, man, because I mean, this ties directly into this scenario of putting the pieces together that we're talked about. Insurance was a big one, man. Insurance, when you're acquiring a facility, identifying up front, prior to the acquisition as you're going through due diligence, what is it going to cost? And we've got a question in here, do you quote a couple of options? Essentially, are you going out and getting quotes from multiple insurance companies and brokers and all these things? What is normally the deciding factor? Also, when buying a facility, is it common practice to keep the seller's insurance or do you get a new one? Really, really good questions here. And a little side note, I want you guys to go out there, a little pro tip. We've got some really incredible folks that we know in the self-storage world. Gary Kelly and Terry Campbell, a couple phenomenal people to get in touch with if you're looking for insurance options for self-storage specifically. But to hit on this, absolutely quote everything, man. Like get as many as you feel or within reason. If I'm going out looking at insurance, I would be looking at a minimum of 3. Insurance is a huge expense for your business.
Yeah.
And so making sure that you're getting the insurance quoted from multiple sources and that you're also not just doing it on the front end during due diligence, but you're also regularly revisiting things with your insurance broker or company or whatever it is that you go through and asking them, are there any cost savings? Let's go out to, let's get some more quotes from some other folks. Let's say you're working with a broker, at least once a year, if not, twice a year. Go to your insurance broker and ask them like, hey, let's shop around a little bit. Let's see if we can find any better rates. And also confirm that you only have the insurance that you absolutely need. Maybe there's some kind of piece attached to this policy that if you got rid of, maybe that there's a possibility for you to reduce that cost. Maybe there's some minimal things that you can do. I've seen companies do random things like implementing simple policies and stuff or safety trainings or different things that, they can show to the insurance companies as they're shopping around and say, hey, like these are the things that we do, for safety and for training and these other things for employees. And you can actually end up getting discounts in a lot of different ways. So make sure you're talking to those brokers and insurance companies.
The insurance has been so crazy the past few years. I think what I'm hearing from, at least in the storage world, it's starting to stabilize now. That doesn't mean it's going down, but it means that it's more known of like what the insurance is going to be as opposed to it crazy spiking like it has the past few years. But that could change. Like, and so I think for that, it's like like Connor said, like it's going out and regularly getting quotes. And like keep in mind, you can do this yourself. You can go and search for insurance on your own. You don't have to use a broker. The benefit of a insurance broker is they can go look at dozens of different options for you, and you'll pay them a fee for it, but they might be able to find you a better option that you couldn't have got on your own. But if you're going to do it yourself, like Connor said, having multiple options for it and not just going for one and saying that's what it is really important, because your two biggest expenses, especially on a smaller facility, are almost always going to be your property taxes and your insurance. And your insurance can really make or break a deal for you, especially if you're in these coastal areas that have flood insurance, coastal Florida, coastal Texas, like just that one line item can crush a deal. And it's something that you really don't want to get wrong in your underwriting, where you think your insurance is going to be whatever the cost is, and it actually ends up being double.
Something really quick, when we were talking about structuring these deals just prior to this, I wanted to make sure that you guys understand too, that if you are doing deals like this, where you're setting up this lease option for so long, you've got balloon payments, you've got all these things, just really make sure that your PSA and all these agreements that you put together are solid with that seller, and that there is no possible way that you go in, work for the next 90 days to turn this facility around, or 2 years or whatever it is, and then somehow you're pushed out of the deal or don't have the option to purchase it, or whatever the scenario or the case might be. Just make sure that those contracts and agreements are extremely clear between the both of you. Make sure you're utilizing legal counsel as you're navigating those things. Ask all the questions, make sure operating agreements, all the things are in place that you potentially might need in a situation like that. If you're doing something creative, again, every deal is going to be different, but make sure you're leaning on legal counsel and setting things up in a way where you're not like working your tail off to do something and then you get something pulled out from underneath you.
The biggest thing that would suck in this situation is if you do such a great job doing a value add execution on this and you don't get the benefit from it because you don't own the real estate. Like that's really what we're trying to avoid here, and having your contracts dialed in is going to be the biggest way to protect yourself there.
We're talking about not doing things on an island, right? We can't do things on our own. This ties really great into our next question about structuring deals. I mean, what are the common ways we're seeing them? How do we structure deals? How do we talk to investors about these things, or potential investors? This is such a difficult and nuanced topic to dive into. Straight up, we've done a number of episodes on the podcast talking with folks like Ben Gottfredson, who's done a ton of partnerships. We've done one with AJ recently talking about just common deal structures and how things are put together and what we've seen. But all said and done, when it comes to bringing investors into your deals and structuring it, obviously you're going to start with your underwriting. You need to see what this facility can potentially do, again, based on data-driven information, known decisions, known rates, all of this, known data. And then from there, you can start playing around with, and I know a lot of people have their own tools, and I know we've got some templates, but people will play around with, okay, if I split the equity 70-30, or if I split the equity this or that. A lot of times you'll see the general partner. So let's say you're the person that's coming in as the general partner. You're bringing the deal to, friends or family, or you're going out and getting investor capital, whatever. Generally what you'll see is people will take 30% GP and they'll do like 70% for the limited partners. The limited partners are those that are just bringing capital. They're not operating. They're not making decisions. Quick caveat on this, for me personally, just having worked in this world for the years that I have with AJ and seeing some of the hurdles that they've had to overcome, I would not do anything other than bringing in limited partners. I would always want to maintain decision-making control. That's me personally. If you're going out and let's say you're going to raise capital from George and you've never done storage in your life, like George is probably going to want a little control. And that would make sense. So don't just have that expectation that, like, if you have no experience, you don't have a track record, that you're just going to go raise capital and somebody's just going to give it to you and not have any say in how things go operationally. But if you can, and you've got the experience, you've got the know-how, you are confident in executing whatever business plan and acquisition you have in mind, then it's great to maintain control. And another caveat, this is just one example. The 70-30 situation, you could do 60-40, all these other things. And something that you need to play around with in your underwriting is and understand is that there's a difference between splitting your equity and splitting your profit. So when you're talking about the equity split, you're talking about the ownership, like who owns what percentage of that asset. When it comes to the profit, you're talking about how much of the cash flow are you guys sharing. So you could actually bring somebody in to be a, 10%, 20%, 70%, like LP, whatever it is. But then you could do a totally different profit share. So let's say you did the 70-30 route. You take 30% as a GP, offer 70% to your capital partner on the equity side, but then you could totally do the opposite on the profit sharing. You could do like, hey, I'm doing all of the management, I'm running everything. So I'll give you 10% of the profit. I'm going to take 90. We'll split it 90-10. Like you could literally approach anybody with any option. It just has to work and make sense for you and your business plan and that facility. So it's just about plugging those numbers in, seeing what you can achieve with the facility, seeing what you can achieve with cash flows and what you're willing to share, what you're willing to give up, and likewise for those folks that you're going to bring in as investors. But I mean, there is no set way to structure a deal.
If you're looking for more on this topic, I would encourage you guys to go listen to other episodes that we have because we go full on in depth on this. Some of the things that I would say, like when you're talking GP and LP, you're going the syndication route. Like work with the syndication attorney. There's a lot of documentation that's involved there. That's not the only way to do partnerships. You could do, there's joint ventures. There's other types of ways to partner with people, by all means. But if you're going for some type of syndication, like work with a professional who's done it before. When it comes to your underwriting, it's really important for you to know what do you want out of this investment of self-storage, and then what is it that you need? And then how can you create opportunity for the type of investor that you're wanting to come be a part of this? Like how involved are you going to be? How much capital are you going to bring? Do you need to bring? And then how much capital do you need that person to bring? Maybe you're really good at the operations, but you need help with marketing. And so you are looking for some type of pure partnership where it is you have some operational control, but you're looking for someone to be a little more actively involved as well too. Or do you just purely need capital? Because then that allows you to go and have those conversations with the type of partner that you're looking for. Maybe someone wants to be more hands off, or they're trying to, they care more about the depreciation. And so they want to be able to structure that into the agreement. And so knowing what you want allows you to kind of see what you're willing to give up to bring in someone into that opportunity. And then the biggest thing is making sure that what you want and what your partners want protects the asset to actually fuel what you guys are looking to do. And then the last thing actually to add to this is clear communications on timeline and expectations. Like we always say this, like storage does not get rich quick. And so understanding that the investors or partners that you're bringing in, it's like, we're not looking to say we're going to buy this facility and in 6 months we're going to sell it and get our money back. Like this is a multi-year process, and that should be, you want to be communicating and attracting the people into these opportunities who have that same type of horizon outlook that you do.
Yes, man. No, that is gold right there, because you go and you raise capital from somebody that's like, they just want all the cash flow. Like they could care less about anything else. Then you got the other folks out there that they just want to park the 1031 cash, or they just want to, gain some tax benefits, whatever it might be.
Yeah.
And if, you're not aligned with those objectives, that can be a really not fun scenario. So we're sitting here talking about like, we could overcomplicate this process. Like, I mean, there's a million different ways to structure deals and bring in investors. And this also ties into keeping things simple, which we had a call the other day with one of our members, and incredible call. And a couple takeaways from that call that somebody posted that I want to talk about here is this idea of keeping things simple when it comes to analyzing markets. It's like demand, like is demand there? Is it not? And identifying what that looks like for that market. And then another piece that was brought up was managing risk by phasing things out. where instead of going and building, 6 buildings and trying to lease up 100,000 square feet or whatever all at once, 50,000 square feet, acquiring a property, maybe it's that value add scenario where you're doing an expansion. Instead of building everything at once, build a building at a time. That's what this individual did. And they were able to not only build to the demand of the market, which is amazing, but as they phased it out, they were able to gauge what the fill up rates were looking like. And once like they had done a couple expansions on this same property, they identified like, hey, yeah, we've kind of slowed down as far as our lease up rate goes on this last one. We're going to hold off for a minute and make sure that we get to this comfortable spot here. We're doing rate management, all these things. That's such an amazing strategy. And so I really wanted to make sure we hit on this today because I love the fact that somebody posted this in the community and shared these amazing takeaways. Because I think so often, man, we've got a million different metrics we can be looking at. We've got a million different things going on, directions we can go. I mean, we just talked about how like the options are endless for structuring deals. And so I think it's a prime example where it's like, hey, like let's reground for a second. Like, is there demand? And let's do things like just that make sense, that are logical. Let's phase out our development or let's phase out some improvements as opposed to just gangbusters trying to do all the things day one.
Yeah. And I want to shout this person out specifically too, because this is Nate, one of our inner circle members, and he joined. He's like, I want to get to over 10 facilities in the next year. And he did that. He just took over, I think it was a 7 facility portfolio in one transaction, and he had bought a few others.
It's amazing.
And so what Connor's talking about was, I think these are some of my favorite calls we do in the community is member success or case study calls. So Connor and Nate hopped on and walked through with the rest of the community everything that Nate did to take that down. And I think that what's so cool about that story is that it seems so massive, like holy crap, 7 facilities, a 7-facility portfolio. But the opportunity that Connor's talking about was based on fundamentals and keeping things super simple and ultimately coming down to demand. And I think what was cool about that too is like then we have other people in the community talking about all the things that they learned from Nate's story. And so it's not just like all the value that we try to bring on our team from SSI with myself, Connor, obviously AJ, but then we have the members in our community who are just bringing so much value on their own rights. It's really cool to see things like that come together.
And that's such a incredible talking point there is just the value of just the people that we've got, man. And Nate is just such an incredible person, through and through, business aside, like he's just such a great dude and out there helping, you see him active out there, helping folks in the comments and all the things and sharing his insights. And I mean, we were just talking insurance, he comes from the insurance world and he was in there giving some pointers on the insurance side. And it's just cool to see, man. It's cool to see because it's that whole rising tide lifting all ships. And, we're all in it together. We're sharing all these things in real time, going through it.
100%.
Because I mean, it's simple, but it's not easy, as you're navigating these opportunities and you're having discussions and you're going through all these negotiations. It can feel kind of isolating. It can feel tough because you're sitting at your computer at 12 o'clock at night, it's almost 1 o'clock in the morning or something. You've got work the next day and you're sitting there trying to underwrite a deal and figure it out. And like there is no one in the world right then in that moment. Like you're there, it's you in the computer in that spreadsheet. And that can feel isolating sometimes. So it's nice to know that you're not alone, man. Like you've got these folks out there that are going through the same exact things, taking away the same value and sharing it with each other. It's amazing, dude.
I think too, like in the world of AI right now, like AI can replace so many things for you. And that's great. And it should, and you should look at how you can use AI in every aspect of your business that makes sense. And you can be up at 12 o'clock, like Connor's saying, using AI to help you underwrite your storage deal, but you're still going to feel isolated. And I think one of the things that AI cannot replace right now is connection and community. And I think another thing that we were talking about this on my call earlier for the deal analysis that we do is the courage aspect to it. Like it takes very little courage to use Google and AI to go through a spreadsheet, but to submit a deal that is going to be analyzed and seen in front of the entire community, and then that you're going to submit an offer on, like that's scary to be like, What if I made a huge mistake that makes me look dumb in my underwriting? Like it takes courage to do something like that, and to be able to be surrounded by people who all have the same goal of succeeding in self storage. Like technology can't replace that yet, and I think that's one of the few things that AI can't replace in the online world these days. And so, like Connor's saying, being able to not feel so isolated is a powerful thing in all business, but definitely in storage as well too.
Yeah, no, you're exactly right, man. You're exactly right. Have you seen anything cell tower topic recently? This is actually, I see this, we've got this comment in here that's, asking about cell towers. I know we've done a lot of calls and things with Hugh Odom, the cell tower attorney. Like,
Yeah.
guy's phenomenal, but I haven't had a cell tower discussion for a minute. This is a great question. Cell towers are one of those beastly things that again, you better be working with legal counsel and making sure that you've got I's dotted and T's crossed. Really understand, the revenue and the risks and how much control. Talking with Hugh and having him on these calls, absolutely. If you're looking at facilities with cell towers on them, or you want to build a cell tower on your facility, have somebody like Hugh that is specific to the cell tower industry, that knows the leases, that knows the language, that knows how these companies operate, so that they can assist you in navigating the best possible outcome for you. Because at the end of the day, you want to maximize your investment, right? You want to maximize your bottom line, and that's a lot of times what cell towers can do. But it, like all things, has to be done right. And a big piece of the puzzle there, talking with Hugh, is that these cell tower companies and the level of access and control that they then have over that property can be extremely imposing, to the degree where, I mean, you've got to consult with them to do certain things on the property or allow access and in those different things, which it makes sense. But there's some of those things that you just really want to make sure and understand. You obviously want to maximize how much you're being paid. So that's another thing where it's, maybe there's these escalation pieces of the contract, and maybe you can get some better escalations or a better lump sum or something that's more in line with value. Again, these guys are seeing this stuff every single day. They know what, these cell tower companies and so forth are paying storage and property owners for these towers, and what kind of, revenue they can potentially achieve, and what's common in the industry, all those things. But kind of like the deal thing, like we were talking about structuring deals, I would go and listen to those episodes with Hugh and just take all the notes.
Yeah, I agree. And I think for anyone who's like brand new to like what do you mean cell towers and self storage, like the benefit to it is that it's pretty passive. Like once you get the contract done, you're just collecting money from that. Like you're not really doing anything for it. And so like sounds great in that one nutshell of a statement, but it's what are you giving up for that, and could that land be better used for something else? And sometimes the cell tower is the best option. But I think like what Connor is saying, like, Hugh Odom, he's been on multiple times on the podcast that you guys can listen to, and he's been on community calls. And I think it's always enlightening listening to him because of how much experience he has in going through those contracts. Because so many people just simply focus on like, well, what is my monthly payment? But they miss out on what am I giving up to get that. And I think Hugh does a really good job of explaining, one, some of the things to look for. But if you are looking at a facility that has a cell tower on it, or you own a facility or contemplating adding a cell tower, like working with someone who has gone through that hundreds of times, I would highly recommend that, as opposed to trying to go through those monstrous contracts on your own.
Oh yeah, there's no way, dude. There's no way. No, thank you.
Yeah.
Those attorneys, for whatever reason, love doing those things. So let them have their fun, guys.
That's right.
No, that's good, man. And I think it's really important to look at these things. You said it really well, where it might sound like a really good idea, to make some extra money. And this is like the security deposit situation, like what we're looking at here. And this next comment is, people are asking, do you take security deposits? Like, how do you manage these things? It might sound really good in the beginning to say, hey, yeah, we're going to charge this fee and that fee, and we're going to do all this security deposit thing in case somebody, jacks up a unit or whatever. We're going to do this cell tower thing. Like, up front, it might sound great, but as you dive into it, you might realize, hey, that actually, like, I'm spending more time on this thing that just isn't driving the needle for us. that investment just isn't worth it. Like, you're just not getting a huge ROI. This was not only security deposits. So I'll touch on a couple things here, but security deposits and truck rentals were actually two things that we just totally did away with. Working with AJ and these guys over the years that I did, because there was just so much time being wasted managing these things that, again, really weren't moving the needle for us in our, how we operated in our business model. Again, not to say they wouldn't work for anybody out there, because people do find success doing these things. But for us, the juice just wasn't worth the squeeze. We went in a different direction, said, hey, like, doesn't fit in the business model. Let's shift. And security deposits were that same way. We didn't take security deposits. It's one of those that for us, the logistics of collecting the deposits, keeping that cash on hand, stored somewhere,
Yeah, it's not income for you.
no, yeah, it's just this lump of cash that sits there that you have to then also pay back or not pay back based on, whether or not you think somebody deserved it after they move out because they, messed up the door or scratched the paint or whatever it is. And so we just totally did away with security deposits. We would charge tenants, if there was damage to things, we would absolutely pursue those tenants and say, hey, like, you did X, Y, and Z. Here's the receipts. It cost us X amount of money to fix this. And here you are on camera backing your truck into the building. So here's the invoice. Like, we would do those things. And we had implemented at one point in time, like a unit alteration, fine, essentially, because you'd have people go in there and want to put shelves and these different things where it's like they move out, you go in and you've got like this loft that somebody built. And you're like, dude, like, this is not your freaking garage, man. Like, this is our property. What are you doing? And so we implemented, in our leases, doing this unit alteration fee or fine that was like however many $100, I can't remember how exactly. I don't think it was a set amount, but it was just like, we're going to charge you for anything.
It costs to get it back to normal or something.
Exactly.
Like that. Yeah.
Right. So, yeah. And yes, it's like hundreds of dollars to have somebody come out and tear a freaking loft down and junk all the stuff and get things fixed to where they should be. So, fun stuff there. But yeah, I don't know if you've got any other thoughts on the security deposit thing, but dude, it was a nightmare for us. We're just like, we're not doing it. We actually, like, on acquisitions would either just refund the money back or apply it as credits to people's rent, because we're just like, we don't want to hold on to it.
Yeah. It's hard to say there's a universal answer of like, never do security deposits. Having said that, like, that has been like Connor was saying, the strategy that AJ and Cedars has shifted towards is like, rather charge an admin fee or deal with it for someone who breaks something when they move out, that you're just going to send them a bill. But ultimately it's like, look at it from your own standpoint as well too. Like, I've seen the argument people make of like the type of market that they're in. There's issues when they move out and they can't get people. They can pursue those people, but they can never get them to pay those fines or whatever it is. And so, if you're really uncertain, then pull the data on it at your facility and see. But I think at the end of the day, there's just a lot of logistics to the security deposit, and because it's not income, you're just holding on to money for them that if, then you have to send back, and it's, changing to a fee structure, something that's for us has seemed to make more sense.
And you'd mentioned using AI for underwriting, and this is another thing that's perfect to tie us into this next thing is AI and how people are using AI in self-storage. And I want to be able to just hit this real quick. I think the biggest opportunity for AI in storage right now, I mean, one of them, there's a plethora, but one of them that I see being most prominent and helpful on the operations side is the call center situation.
Yeah.
And having that 24/7 virtual AI agent on the phone that doesn't get upset at tenants, that's more consistent than any employee you're ever going to have, more consistent than any call center you're ever going to hire. And there's some incredible tools out there, one of them being Patchwork Labs. Patchwork Labs, they are building that exact piece of technology specifically for self-storage. They're self-storage investors, owners, operators, and they've built this for themselves and for the industry. Much like AJ and these guys have gone out and built things like Tenant Inc. and Store Local and some of these other resources. These guys have done that in the AI world for self-storage, and they're working on a lot of incredible things. I personally love the idea that you can have this scenario set up where people that, they're calling the facility, whether it's payments, whether it's the gate, or whether it's this or that, no matter what's going on, that AI agent can handle that scenario and process it. They can send you information to where, if there's some kind of emergent situation going on where you solve it and can get involved in all the things if you need to. But just an incredible way to really truly reduce operating expense on top of providing more value for folks. I know we had one of the folks from Patchwork Labs on recently that talked about and shared that, I mean, like, what was it? 80% or more of the folks that call in don't even realize that they're talking to this AI, and they think they're talking to a person. So, and it's only going to continue to get better and more advanced. There's a number of different other things, from rate management to market analysis to, I mean, expense management, and all these different things that you can utilize AI for. But the call center thing I love.
Yeah, the call center is great, and especially like not just on the admin side, but even on the sales side as well too. If someone calling to rent a unit, but the admin
Yeah,
especially being able to have your processes that can just be explained so easily on a phone that you don't have to train a person for. I think like to zoom out on the AI aspect, it's like try to see how it can be impacted on every single aspect of your storage business. Can it help improve your SOPs? Can it help review your expenses? Can it look at your overall marketing strategy? Like I would try to incorporate it in as many places as you can, even if it's just to say like this was not helpful, so I'm going to continue doing it my own way, and AI is not ready for this yet. Like I think it's a worthy practice to use it as a way to audit your own operations.
absolutely, man. Absolutely. It's such an amazing tool. Definitely encourage people to look at it. But George, man, amazing episode today. Guys, if you've got value from this, please leave us a review. Helps us out a ton. Leave us some comments on YouTube if you're checking it out on YouTube. As always, it's great to hang out with you, George, and talk shop, self-storage.
Yeah, thanks so much, everybody. Catch you next time.
See you guys.